time, people put 20% down payment on a house because they want to eliminate what's called private mortgage insurance, otherwise known as PMI. For me, I still prefer to put only 5 or 10% down, and I'm still able to eliminate PMI over a short period of time, like 18 months. In this video, we'll go over it all. Let's do it. Hey guys, welcome back to Lifestyle Leaps. I'm Diem, and here we're talking about ways for you to take big steps to reach early financial freedom. Today, we're talking about private mortgage insurance. Now, let's talk about what that is exactly. Private mortgage insurance is actually something that protects the lender. It is put in place whenever a buyer puts less than 20% as a down payment. You don't look like that strong of a candidate potentially, so they want to put steps in place in case you default on your loan. Private mortgage insurance costs anywhere from 0.5% to 1% of the loan value. Pay it with your monthly mortgage. And in my example, I'm going to show you later how I'm able to save that $230 expense each month by eliminating my mortgage insurance. Now, let's break it down in terms of how this affects your down payment and what better use you might have for that money. Here's why I never want to put 20% down on a home. Let's take, for example, a house that is $500,000 and 20% down payment is actually $100,000. That feels so much to me now, but that feels even more to me back when I first bought my first home or my first few homes. So compared to a 5% down, which is only $25,000, the difference, $75,000. So let's imagine on that home and you're putting 5% down, your PMI is probably going to be around $185 a month. And that means that in a year, it's going to be $2,175, okay? Now, how many years of saving on PMI will it take for you to recoup what you would actually put down as a payment to avoid PMI, which is a $75,000 difference? It's going to take you like 34 and a half years. I'd rather spend that money today on a different investment and have cash flowing property instead of sticking it all in one place. Now, you're going to argue, well, DM, if you put more money down, that means you will have a better cash flow, right? Because now your monthly mortgage is less, you have less PMI, and you also have more money going into the equity and less interest rate. All of those are true, but you've got to keep in mind that if you are going to be renting your home at any point while you're living in it or later, or if you're buying it as a second home and you're going to have renters right away, let's say you put it on VRBO or Airbnb, who's paying for that? It's not even you. You're trying to save money that you're not even paying for. Meanwhile, if you're able to buy, let's say, 2 homes with that $100,000 instead of 1 home, do you think that cumulatively the cash flow between the 2 houses will be more or less than the 1? I promise you it's going to be more. So that's the reason why I never really want to put 20% down. I prefer to go with 5% owner occupied or 10% for a second home that I'll rent out. Let's not forget that mortgage insurance is actually also tax deductible for investment properties. And if you live in the home and you rent portions of your home out, that portion of your PMI is also tax deductible as well. So those are ways to help you understand why it's not as big of a deal as you anticipate that it would be. Okay, so let's do a personal example. The house that I currently live in, I bought it for $675,000 in the 4th quarter of 2020. I put 5% down, which is $33,750, okay? If I was gonna put 20% down, it would have been $135,000. Hell no. Did I also mention that I had the seller pay for closing costs, even though it was a pretty competitive market at the time? I figured, why not? I would ask, their house has been on the market for weeks, it hasn't sold yet, so I got closing costs covered. I paid $28,000 to do construction on the house, which is to build an outside stairwell and exterior exit so that the upstairs bedroom and bathroom could be closed off and converted into a junior accessory dwelling unit by adding a kitchenette and all of those things. And then the downstairs half bath, I converted into a full bath by adding a shower. And of course, all of those were done with permit. As usual, construction took forever. Meanwhile, I was still having to pay my mortgage insurance of $230 a month, which really sucked. because I thought I was going to be able to get the construction done in a couple of months, submit for PMI removal, which is a process that would have taken about 30 days to 60 days. But that didn't work out because, well, generally they never really work out perfectly, do they? Construction took forever. Finally, when I was ready to submit for the mortgage insurance review so that they can remove it, after having done that and wait for a response, and 2 months has gone by, they now tell me that they're selling my mortgage to another mortgage company. So now I have to go and wait for the transition to happen and then ask the new mortgage company to do that, which I did. In total, it took me about 4 months instead of just 1 or 2. But in February, they told me that they were able to do the review. They sent someone out to take a look at the property and assess its new value. So not only did I add construction, which increased the value of the home, but the market went up as well. And I'm not sure if he accounted for that. I assume that has to be a little bit of the equation because they're now assessing today's current market value, right? So they approved and recognized that I do now, based on the new value of the home, own more than 20% equity of the home. They removed the mortgage insurance effective of March in 2021, and I no longer have to pay that $230. I'm going to include right here for you what they said is some of the criteria. So it looks like if you own a home and have been paying a mortgage on it for over 2 years, you can simply request to have the mortgage insurance removed if you've reached 20% equity. That could be because maybe you're making larger payments towards your mortgage and then you've reached that. If it's over 2 years, you don't have to do construction. But if it's under 2 years, you have to demonstrate that you've majorly improved the value of the home, not just dependent on the market either. Based on that, that's the route that I took. If I didn't take this approach, eventually mortgage insurance will fall off on its own. But it doesn't fall off until the natural course of the pay down occurs and you've established past 78% loan to value of the home based on the original purchase price. Whereas the strategy that I took, they came in and assessed a new value based on the market, based on my construction, and then they realized that I had the right amount of equity to eliminate that. All in all, that was a really complicated experience. Construction took long and the mortgage insurance process to eliminate took longer than time I had done that before for a previous home. But still, I only paid it for 18 months. In exchange, I was able to put 5% down and still have no mortgage insurance after a period of 18 months. Instead of putting that 20% down of $135,000, I used some of the rest of that money to invest in another home purchase and have cash flowing property, new assets, and someone else paying down equity at a different home, plus an extra set of tax write-offs for my rental business. Anyway, if you find that helpful, will you please consider pressing the like button and maybe subscribing too? Or if you want to do a huge favor, you can share the channel, but I don't want to get greedy and ask for too much. Anyway, catch you guys next time.
Oh my gosh, why did not anybody tell me my hair was totally bonkers that whole video?